I've got to tell you a story. I had a first-time home buyer almost lose over $10,000 by essentially not communicating with anyone on his team. I'm going to make sure that you do not make this mistake, give you some tips around what you need to be thinking about and where you need to look to ensure that you are not overpaying when you're purchasing a home. My name is Ryan Skaggs, and this is the Mortgage Minute. This channel is dedicated to everything mortgage, real estate, and interest rates. Today, I've got a story of a buyer. Now, this happened to be a first-time home buyer, but this could be any buyer in general. But a first-time home buyer. I'm going to use some easy numbers here for us. We locked in a 7% interest rate. They had a $500,000 loan. We get about a week into the transaction, and they stopped communicating. They didn't communicate with me. They stopped communicating a little bit with their realtor outside of just a quick text back. And lo and behold, I get an email back that says, hey, we're moving forward with this other lender, one of the largest lenders in the country. And of course, I called, I emailed, I said, let's discuss to make sure this is apples to apples. And again, once we get into the nitty gritty of this, once we dig a little bit deeper, peel that onion back, it was over $10,000 was their consequence of moving forward with that other lender than with the quote I had put together. I'm going to make sure you don't do that. Now, if you made it this far in the video, make sure and click that like button, click that subscribe, and click that bell icon to be notified as I'm putting out weekly videos on the channel. Now, how can you avoid these costly mistakes when purchasing a home? Well, in this case, the other lender just glossed over the documentation and essentially gave them the same cash to close as what I was giving them with a slightly lower interest rate. Now, what they didn't realize is they were paying points to get a lower interest rate. So what are points? Let's understand the vocabulary here before we go any further. 1 point is 1% of your loan amount. So at a $500,000 loan, that is $5,000. They received a quote with 2.125 points to get just a slightly better interest rate than what I had showed them with 0 points, over $10,000. Now, luckily, they came to terms with actually getting on a screen share with me, reviewing the two loan estimates together, and then better understanding what the other lender was doing. And what they had done is increase their loan amount to keep their cash to close the same, right? So they're going to take out a little bit more of a loan, so they bring less money to the table, but then charging them for this interest rate to keep that down payment or that cash to close roughly the same. So completely understand what they're doing, but when you look at apples to apples, they're paying over $10,000 to maybe get $50 in a month in savings. I basically said, hey, if you want me to show you a quote with $10,000 of additional closing costs, I'm going to beat them by over 1% in interest rate. But I do not think this is the best scenario for you. Here's why. We discussed it. We got the real estate agent on the call. We got actually one of their family members on a call, and we all kind of looked at it together, reviewed it, and they came to an understanding of that those points were not going to be in their benefit at this point in time. So 1 point is 1% of your loan amount. Why do people pay it? What is it doing? It is prepaying the interest. So you're lowering that interest rate. I'm in the greater Chicagoland area. You go to a Bulls game, you sit in the middle level. That's a kind of an average seat. Let's say that's $100. If you want to sit right down behind the bench, maybe that's $500. You are paying more to get that premium seat. In this case, you're paying more to get that premium rate, to get that lower interest rate. You're buying it down. You are saying, yes, I'm willing to pay X amount of dollars to bring my rate down. Now, is that good or bad? It totally depends on you and the market. So there can be times when it makes a ton of sense, and there can be times when it makes 0 sense. Here is how I would have you evaluate this. You need to look on your loan estimate on page 2. Check out the screen as I talk about it. In the top left-hand side, it's going to tell you points. This is one of the changes that came to the lending industry to be very transparent of this line item, right? Sometimes people only look at page one as a summary. They see a lower interest rate and they see, cash to close, it's roughly the same when they're not getting the full picture. They turn to page two, they look in that top left. That will tell you exactly what's going on in terms of, are you paying to get said rate or to get those terms? Now, what I typically tell people and how I educate home buyers is take the cost and then take the monthly payment savings to create a break-even point. If you have a cost of $5,000 to save $50, that is going to be a very long time, 100 months, right? So that's going to be a very long time to get that money back. That is likely not in your best interest. If you're going to spend $5,000 to save $500 per month, holy cow, that makes a ton of sense. That's only a 10-month break-even point. The math is in your favor. That's less than a year. So you want to consider right now in 2024, we are hopefully seeing a depreciating interest rate market where we're going to see lower interest rates by the end of the year. Right now, we're still hovering in that mid to high sixes. We've been there here for the most of 2024, though we did see in January a little bit lower, but then some higher inflation numbers pushed us up a little bit. So time will tell, but every projection possible shows us a lower interest rate by the end of 24 and going into 25. So in this case, if you're going to see a lower interest rate in the future, why are you prepaying to do it now? You need to look at that break-even point to make sure that it makes sense for you. So do not make this mistake. Do not gloss over. It is so incredibly important to have a transparent and honest lender on your side. This is going to be likely the largest asset you're ever going to have. It's going to likely be the largest liability of your life as well. So why just gloss over, e-sign, don't review anything, don't ask any questions? You need to be looking at it and taking the time and effort to review it, ask questions, understand, go through line by line. So therefore you can see what the reality is of the cost associated with this whole thing. I know it can seem confusing, and especially some, as I talked about, apples to oranges, but there's always a way to get to apples. So you can review two options or two lenders or two whatever, right? So if you've got questions, if you've got comments, if you paid points, do you think it's a good idea? Put that below. I'd be forever grateful. Let's start a conversation down there. So thank you so much for tuning in. Again, if you made it this far, click that like button, click that subscribe, click that bell icon to be notified, putting out weekly videos. Stay safe, and we'll see each other again very, very soon.